when and who should be concerned about tax deductions?
Because your number one job is to keep my husband out of jail.
What are the most common deductions that people miss or don't think of? Can you help us understand from an accounting perspective the difference between a sole proprietorship, an LLC, an S Corp, or a C Corp? Hey there, and welcome to From the Ground Up Show, the show where we inspire and encourage the next generation of free-thinking leaders by telling the stories of those that have been there, done that, and are still getting it done, building a life that they love with their hearts, their hands, and their hustle. I am your host, Eric Loden. If you guys are enjoying the content, please help us out. Like, share, follow, subscribe, all the things. We're on all major podcast platforms, YouTube, and on social media. If you guys could leave us a 5-star review, that would be great. That really helps move us up in the algorithms. And don't forget to click that auto download button to make sure that you guys download every episode each week. I am re-recording this intro because we had some technical difficulties and the audio for this interview got goofed up. Let me apologize in advance. We fixed these technical issues, so I promise the audio will be better next week. Please come check us out again next week. But the content here was too good to ignore. I've done my best to clean up the audio, and we are going to re-record the intro and some of the things that we can. So please stick with us as we make the best of a tough situation, and make sure you come back next week. This show is a little bit different. Typically, we highlight individuals that have foregone the traditional white-collar career track of college directly into a job. We focus on blue-collar entrepreneurs and those that have just blazed their own trail. But today, we are going to dive into the depths of a white-collar career track. We're going to interview a CPA, and the idea here is that we should be able to get some advice very applicable to our listeners that are in the blue-collar trades, that are entrepreneurs doing their own thing and try to figure this out. So I am really excited to have Dan Godwin joining us. Dan is a tax specialist and CPA living and working in Sheridan, Wyoming. He grew up in a blue-collar family and now serves many of them in his capacity as a CPA. Dan is a proud father of 2 children, a grandfather to a beautiful 3-year-old girl. He is now a partner of Mohatt Johnson and Godwin and has been handling my taxes and my business dealings for many years. I can personally attest to his knowledge and experience. We are truly honored to have him on the show. Dan, thanks for joining us.
Appreciate you having me on.
Awesome. Well, the first thing we do every show is we want to learn a little bit about you. So can you tell us a little bit about how you grew up and where you come from?
Well, I pretty much grew up in Sheridan my whole life. I think I moved, I was born in Illinois, but I moved out to Sheridan when I was about 3 years old, and have lived there ever since. I had a short stint away for college and did some work in Casper right out of college, and then it was about back 2004 and back to Sheridan, and I've been there ever since.
Okay. I know you mentioned that you grew up in a blue-collar family. Can you tell us a little bit about your home growing up? What was life like as a kid?
My dad, for my early years, my dad owned a commercial DuPont paint store. He liked to paint Harleys and old cars and things like that. So he sold retail commercial paint and did some painting on the side. And and my mom was similar. Worked in an auto parts store. Worked at the CarQuest in Sheridan for many years. She was more of a bookkeeping hand, but worked the front desk of the auto parts stores and things like that.
Do you share your dad's passion for Harleys and sports cars?
No, I never did. Harleys, the motorcycles scared me to death.
Well, I know as a CPA, you have some secondary education. Can you tell us a little bit about your education and what it takes to become a CPA?
Well, the education track took me on a lot of different paths. I think my parents thought I was going to be a doctor by the time I got done, but ended up being an accountant. I left high school, and my number one goal was just to go find a place to go play football. That was my big passion back there when I was 18. And you find out right away that it's not for everybody. And, your high school sports are probably the best times of your lives. And so I chased that around for a couple of years. I went out to Minnesota and played, and then I went back to Helena and played, and ended up just deciding I wanted to go to college. And so ended up at the University of Minnesota for a year, and ended up transferring back down to the University of Wyoming, and ended up getting my undergraduate degree there and my master's degree in tax at the University of Wyoming.
Okay, so how do you go from college to a partner at Mohatt Johnson and Godwin? What was your career track like?
Well, college gives you the basic background, kind of some of the tools you need to understand what you're going to be working with. But it seems like the partnership track in an accounting world is a little bit longer than maybe say the legal world. There's a lot to learn. The Internal Revenue Code is vast. And so to feel comfortable enough to sit down and have clients pepper you with questions and being able to think on your feet and try to answer those questions, you need some experience. And so I started working in Casper in 2000. I started out in auditing, and I knew right away it wasn't for me. But the firm I worked at was auditing and tax, and I really enjoyed the tax work. So I shifted over to another firm down in Casper and did all tax. And then when I got up to Mohatt Johnson and Godwin, it was a different firm name at the time, but it was about 2009, January of 2009, when they asked me to become partner. So it was a good 8-9 years of just kind of grinding away and hoping someday you got that opportunity. And so I've been thankful that I've had that. The previous partners, John Pradiers and all those that everyone has gave me that opportunity, and I appreciate that.
Yeah, it sounds like an important part of that career track is picking the right partners to go to work for early on. Did you know that coming in? Was that done strategically?
Well, coming from Sheridan and knowing that I wanted to move back, it's a small community. It's really similar to Buffalo, right? And so you start asking around and where's a good place to go? And Mohatt Johnson and Godwin, the firm at the time, was the name that kept coming up, and so that's where I applied, and that's where I've been ever since. But you want to make sure in any business you're going into business into partnership with the right people. Makes it you want to try to make it work a little bit fun.
Yeah, that's great. What were some major turning points or maybe some pinnacles in your career that you remember?
Turning points. Oh, well, the auditing would be the obvious one. I started interning for a firm, and I would leave on like a Thursday, and I'd drive to random school districts across the state of Wyoming and audit a school district for 3 or 4 days at a time, and I just knew that it wasn't for me. So that was probably the first big career change for me. And I was still obviously doing accounting, but auditing and tax are two different worlds, and so that was the big career change for me within the profession. Yeah.
For those of us that aren't in the tax world, can you help us understand maybe the differences of what kind of things you do in the tax world versus auditing?
Well, the auditing is, I always laugh. The school district over in Ethiopia, Wyoming Indian, I just remember you show up and the district manager rolls in with the cart, and he's just got inkjet files just stacked up on top of it. He just drops them off in a room, and you're going through and just testing transactions one after another, and it's just a lot of paperwork. But you're testing for fraud, and you're doing all these other things, internal controls, and you're giving them an assurance that their financial statements are accurate. In the tax world, we're focused on let's try to minimize our clients' tax liabilities. Let's work with them on a plan to do that. Let's work with them on a plan to get set up for retirement, down the road. And every tax return is a little different. You got a radish client that's much different from a roofing client, right? And so to me, it's there. A lot of people tell me like, oh, your job sounds boring. You do the same thing every day. But to me, there's intricacies between each client that are different that kind of makes it a little more fun, I guess, so to speak.
Well, I'm probably not cut out to be an accountant either, but I sure know that auditing is definitely not for me.
Yeah, that was a tough one.
What was the most difficult thing you have faced in your career?
Well, I was thinking about that, and I think I probably have to break that up. Like, in your personal life, and again, this isn't just for accountants, this is anybody that wants to be self-employed and run a business, is finding a good work-life balance. A lot of times we do this, we start out and we're young, we're getting married and we're having children, and you're trying to figure out, how do I balance these things, but still be able to be successful and serve your clients. So that was probably personally one of the toughest things. I worked for some guys down in Casper, and this guy's name was Jack, and I'd show up every morning during tax season at 4 a.m. and I'd leave about 6 or 7 o'clock that night, and I'd show up the next morning and I'd have a sticky note on my computer that said, "Where are you?" And so I think part of it was kind of, in jest, but at the same time, he had a question and I wasn't available. And so just learning to say, okay, I've got to do a good job at the office, but at the same time, my wife and children needed me at home too. So yeah, that was tough. Professionally, it's just, you come out of college and you don't know anything, and that might be a difference between, like if you're a good electrician or, or a good contractor, you know what you're doing when you get started, and there's some different hurdles, but I come out of college and I've read the textbooks on tax, and I understand what depreciation is, or retirement accounts are, and things like that. But applying it to the real world and being able to communicate that to your clients, that's hard, because it's a daunting challenge to try to take what you've learned in college and then apply it to the real world.
I can imagine that. In my own business education, I actually studied accounting quite a bit, and I actually had enough accounting credits I could have sat for the CPA exam when I graduated. But the first year I went to look at my own taxes is like, oh man, I've studied all this stuff and I don't know what I'm looking at. I don't know what to do, and that's why I work with a professional like you.
When I first went to college, I thought I was going to be some sort of a sports trainer, and when I went to Laramie, I was like, yeah, that's just not for me. And I was like, I'm just going to take a business path. And I started taking some business classes, and I took accounting, and my wife at the time, she had already taken the class. I was lost. I was like, debits and credits, what's this mean? And we're still good friends to this day, and I tell her all the time, if you hadn't helped me get through accounting, I wouldn't be where I am today.
That's great. So an accountant's education goes a lot further than just your schooling. You have a lot to learn as you dive into the industry.
From an accounting standpoint, though, since then, I think the biggest challenge I've had in my career was COVID. The number of tax law changes that came out starting in like late 2019, 2020, there was all the money that was available, and everybody was trying to get their fair share of that, whether it was through payroll credits or, whatever. It created a lot of burnout, and it's affected our industry. With the accounting world's very, very old. The average age is getting up there, and so people are starting to retire. And I think we saw a big drop off for a lot of those people. We lost one of our partners because he's like, COVID was too much. He's like, I can't do this anymore. So it created a lot of burnout. COVID was tough.
So has that turmoil continued the last couple years, or was it kind of focused there in 2020, 2021? Has it settled out, or are things still changing a lot?
Yeah, we kind of joke because we still people probably heard of PPP loans and employer retention credits. The IRS is just recently starting to release some of those employer retention credits. 4 years later, and so when our clients are bringing these letters in, we're like, we don't want to hear the word PPP anymore. It just brings back that PTSD type of a situation. Yeah. So, but it's basically, it's for the most part worked itself out, and we're kind of getting back to.
Okay. Do you see some young blood coming into the industry? Is that maybe a vacuum coming up in the career space?
It's tough right now. Attracting talent in small towns, like Buffalo and like Sheridan, it's hard. There's not a lot of kids that are going into accounting, and I think part of it is that being in public accounting, they hear the horror stories of working January through April, and really those tax seasons are getting condensed. The brokerage firms don't send out their 1099s until late February, and then you got till April 15th to file, and they don't want to work those hours. Maybe they can go do it in private accounting, or maybe they can go do something on their own. We go down to the University of Wyoming and try to recruit, and there's just not a lot of kids coming out that want to come back to a small town. So it could be the hours, it could be the pay. I'm not exactly sure. I think that our industry as a whole, I think they make it too difficult with the testing to try to obtain your CPA. And so we've had to kind of shift our focus on who we're trying to attract. Take chances on maybe a kid that focused on finance in college, but was interested in trying tax. And so we've done that, and we've had some success doing that. And we've found a few young kids that are still striving to get that CPA. Yeah. But yeah, it's been tough, and I think that's probably the case on a lot of small businesses. Help is one of the hardest things.
That's what you hear from small business owners across the board is, finding help is hard, and then finding qualified help is impossible. So how do you manage the seasonality of your business? I mean, is there a way to find some balance there, or do you just take off November and December every year to get ready for the chaos in the spring? How do you manage that?
We work hard, and a lot of taxpayers and clients. Tax season is stressful on them. It's stressful on us because we're working a lot. It's stressful on them because they don't like the word IRS. They don't like those letters. Internally, it just creates, tension, angst. And so that people don't want to get extended because they just want to get it over with and put it behind them. And they don't want to have to worry about it. We could extend your tax return until October, but that's another 6 months of worrying about it. So we're trying to get as much done. But when I first got into the industry in 2000, we worked hard, through April 15th, and it felt like we had a 2-3 month break before extension season would kind of pick it up. It's not like that anymore. We're working year round, pushing hard through the summers even. And I don't know if that's just because there's not as many accountants and we're taking on more work, or just naturally we're having to extend more and more clients because the tax season itself between January and April was so condensed, and we just don't have the time to push out that many tax returns. Yeah. So
I can attest to that on the client side of things. My secretary, treasurer, and I plan on working New Year's Day every year because we try to put together everything that we need to give to you so that we can be the front of that line and we aren't waiting, wondering when the KGB is going to show up wanting their money.
Like this year, the IRS has already come out and said, because they always shut down here for a few weeks to do all their updates with their computers, and they said the filing season won't open until at least the first week of February now. Wow. And so normally it might be the second or third week of January. So that's just going to push us back even further. It doesn't mean we can't get in there and start working on things and get them ready to file and things like that. But, the people out there that pay attention to that news, they may not even think about doing their taxes until later now when they hear that type of stuff. So still get your stuff together. January 1st.
January 1st, your email will start ringing from me. What is something that you wish you would have learned earlier?
Oh, I think the biggest thing for me is you learn how valuable communication is. It's not necessarily I wish I would have learned more about taxes earlier. You go from being a young accountant into thinking about yourself as a partner. And when you come in, you're really focused on still doing the tax part of it. But what you find out is now you're in charge of that business relationship with the client. And so the communication with the client is probably the most important thing. And so you don't really have those opportunities when you're young, and they're just saying, prepare this tax return, prepare this tax return. So that's probably the biggest thing that if I'd have known early on, probably would have made the start of my partnership position a little easier.
Yeah.
I think that's probably the main one.
That's something that applies to a lot of industries. We see that in the trades. There are some people that are excellent at what they do. They're great craftsmen, but they have angry or disappointed customers because they're just not great at communicating. It is a totally different skill set than having the skill of whatever your craft is and then being able to manage customers. They're two totally different things, and both affect the customer.
Yeah, and I hear it, and you hear it talking to different people. Like, I called contractor X, and he won't even call me back. And we're the same way. I mean, we get busy like you guys do. I'm not saying I have a response time of 5 minutes or anything like that, but they, even if you're, hey, I'm gonna get back to you. Just give me some time. And if you're calling them back a day or two later, they still appreciate at least getting a response.
Yeah.
So I think that's good for whether it's my industry or any other small business, is just respond, and let them know, and if you don't have time to do it, at least call and tell them you don't have time to do it, because that'll help you down the road. During, you're busy right now, but during a slow time, that person may call you back because you may be one of the only contractors that call them back. Yeah. Even if you couldn't help them at that time. You know what I mean?
Is there something that you've changed your mind about significantly throughout your career? Maybe something where you had a pretty set opinion, and as you've matured or grown or seen things, you changed the way that you look at that and your opinion has shifted?
Yeah. I've learned that when you were working in a small business, you're an owner, partner, whatever, you wear a lot of hats. I mean, and I think that's one of the things going into it. Whether it's you're the main contact with your clients, whether you're one doing the tax work, but then you have the HR. You got to deal with you have an employee that leaves unexpectedly, and then you got to figure out what are we going to do. How are we going to get the work done still? How are we going to get that position filled? You got to care about the financial well-being of the firm. So which partners are responsible for that? So any small business owners wearing a lot of hats, and that to me was kind of because I come in as a young partner, I'm just relying on the elders in the firm to take care of all that stuff for me. But eventually they transition that work to you, and then pretty soon you got to delegate the work, because otherwise you just keep adding more and more to your plate. Yeah. And then next thing you know, you're like, what am I doing? And so yeah, I would say that the HR part of it is hard. It's, because you want your staff to be successful too, and you want them to be happy. You want them to. It's not like you come to work to have fun, but you at least want them to have an enjoyable experience. Hey, they enjoy coming to work, and so figuring out ways to do that is not always easy.
Is there a major mistake that you wish you could have avoided?
Yeah, I can think of one, and being an accountant, and I sit and preach to my clients all the time about use the resources that are available to you. If you don't know what you're doing, go ask the professionals. And I got into a business deal, and I didn't think I needed to have an attorney review the agreement. I got burned on the deal, but that was several years ago, and I learned my lesson. So. Yeah, you just never know. Like when you're dealing with contracts and stuff like that, you read it and it all sounds good. It's not necessarily about what you're reading. It's about what could be missing that you're not reading in a contract. And I think that's probably the hardest part for looking at contracts is what's not in there. And that's what attorneys are good at and have been trained to do. And so I would highly recommend relying on your attorneys to help you in any type of business transaction.
That's some good advice. Yeah, I'm always looking close at contracts because the purpose of a contract is to try to have an even deal that's fair to both sides, but that's kind of impossible. And usually whoever produced the contract, it's leaning a little bit to their side.
For sure. I agree. Yeah, absolutely.
Awesome. Well, we got to learn a little bit about you and your background and what it takes to become a CPA. Maybe the last question on kind of that line of questioning. For a young person out there looking for a career, do you think there's a future trying to become a CPA? Is that still a good quality career track? And maybe along with that, if you could go back and do it all over again, would you?
I would do it again. Like I said earlier, from the outside looking in, people are like, I don't know, being an accountant looks kind of boring, repetitive work. And I just look at it a little bit differently. Each one of my clients is different. I enjoy the interactions with clients. I enjoy sitting down and meeting with them, and having conversations with them. It's fun when you pick up a young client that started a new business, and 15 years later, they're still with you. They're doing well, and so I enjoy that, and I would do it all over again. There's a lot of opportunities in our profession, to go be an auditor, go be a tax preparer. There's a lot of, like I said, the industry is getting older. A lot of them are retiring, and we need young people to come in and start filling those spots. So I think the industry probably needs to look in the mirror and figure out how to make it more attractive. And it seems like the daunting task of having to take a CPA exam at the end of the day. The CPA exam initially was the first test that I couldn't pass. Wow. So why are we making it so hard for people to get into the industry? You know what I mean? The test is a lot of it is just trying to trick you on the questions and things like that. And it's like you have the resources to figure out the answers once you get your CPA. It's the clients aren't going to try to trick you; they want the right answer.
Yeah.
So why do we set it up that way? Maybe back however many years ago, maybe there was an overflow and they were trying to limit who could get into it. But I think there needs to be changes made for sure.
Good to hear. Well, I really appreciate that you enjoy finding a young client and sticking with them. And that's what you've done for me. I think it was maybe 8 or 9 years ago when we started working together. When we first started, we had a business doing about $2 million a year. And this year we're going to break 10 million. And you've just kind of walked with us the whole way. And actually just this week, we closed on the sale of our business. My wife and I exited and are now passing it on to the next generation of ownership. And I think they're going to continue to use you as their CPA as well. So we have really appreciated that stability and growing with us and just helping us learn as we have grown and matured our business. You've been a pretty invaluable resource. So thank you. Now that we've learned a little bit about you, we'll dive into the meat of maybe the advice that our listeners are waiting for and help us all get a little better prepared. I think something that often gets misunderstood, and maybe you could clarify for us, what is the specific role of a CPA? What sort of thing should the customer of a CPA expect? And maybe, like you said, the key part of a contract is not what's there, but what's missing. What are the things that people think a CPA's role are that really aren't?
Yeah, and so you're touching on a couple different things there. And, just the first part of the question, what the specific role? What do you need? A CPA firm can offer a lot of no, what's the word for it? Different types of services. Okay, so do you need bookkeeping, or do you have an in-house bookkeeper? So maybe that's part of the role. And then it just expands from there. I mean, obviously you're there to get tax prep done, but do you need your in planning, or do you got a good grasp on that? Are there transactions that are happening throughout the year that you need advice on, and how to structure that transaction? And so the CPA role should be that they can fill in any gaps that you don't have. Maybe you have an in-house bookkeeper, but you just want somebody to look at your books quarterly. Take a look at them to see if the in-house person is doing it, the way that they should be to help with the year-end tax prep. So that would be the first part. I mean, we can do as much, and this is what I tell my new clients. I said we can do as much or as little as you need us to. If all you want to do is come in at the end of the year and bring me your books and have me prepare your tax return, we can do that. Cost is obviously a concern with that, and it should be, right. Try to minimize your costs as much as possible, but get the help you need. And if you don't need bookkeeping, then and you just want some tax planning and tax prep, that's the role that they should play for you. If they're selling you the bill of goods that we have to provide everything, that shouldn't necessarily be the case. And I know there's firms out there, and that's their model. We do it all, or we won't. We're not a good fit. And if that's the CPA firm's role, maybe that's not a good fit for your business. So go copy the next one. But then the second part of the question, the misconceptions, is I would say the first thing that sometimes gets misconceived is clients look at us as a financial advisor. While we do advise on your finances, we're not stockbrokers. We're not following the stock market. We're not going to help you make decisions on where to put your 401k into. And then the other side of that is legal advice. People think that we can provide legal advice, and that's just something we can't do that. And sometimes it doesn't even seem like it's legal advice. It's like, hey, can you help me get set up with the Secretary of State? Well, you probably need to have an attorney. Get you set up with the Secretary of State, or go online and do it yourself. But we can't do that for you because it's considered providing legal advice. And so I think people look at that and it's like, oh, well, he's a tax accountant, so he should be able to help me with some of this legal stuff, and we can't always do that.
It sounds like that's probably a conversation everyone needs to have with their accountant, and that's something that you've educated me on, and that I see all the time as I talk to other contractors, and as they tell me what they're doing, it's like, oh my gosh, your tax strategy is terrible. Like, well, that's what my accountant told me to do, and I'm usually like, did your accountant tell you to do that, or did they tell you that you could do that? Are you asking good questions, and have you had that conversation of, are they advising you on what you should do, or are they telling you what legally you're allowed to do? That seems like that's a line that often gets blurred, and is that a conversation that people should make a point to have?
Yeah, I mean, I think it definitely can blur the lines. And we pick up clients, and I'm not saying that anybody's out there giving bad advice on purpose, but I have ideas on how I think things should be done. But recently I picked up a client who um, had another accountant doing his stuff and recommended that he was putting real estate into C course. And for me, that's just a general rule of thumb that you never do. When he shows up with 3 C courses and he's got real estate in them, and it's like, okay, now what we need to do is let's figure out how to correct this and move forward. But if there's any question of who should be doing what, yeah, you need to have that conversation with your accountant. And I believe that small businesses, we're all worried about, we got to get out there, we got to build a business, and we've got to control costs, but you need to build a team around you, and so having an attorney that you can bounce questions off of, and talking to your accountant. I work closely with financial advisors and attorneys for a lot of my clients. They built a team, and then they'll say, I don't really know the answer to this or whatever. Can you call the attorney or can you call the financial advisor? And then we start talking, and that's how it should be, in my opinion.
I love that you guys do that because, yeah, the end of the year is always crazy for us as business owners. There's all kinds of stuff happening that's over my head. And so the fact that you work with my financial advisor and I just sign a letter saying that you guys are allowed to talk to each other, you guys can just take care of it, and I don't have to be in the middle screwing stuff up. So another lesson that maybe I learned the hard way is I was working with another CPA before I started working with you, and every year I would ask, is there something different I should be doing? And I thought I was asking the question, asking for some good advice on tax strategy. And one year I came in frustrated and was like, hey, how come you didn't tell me I should have done this? And he said, Eric, my job is to file your taxes, not tell you what to do to avoid them. And we were just kind of missing each other. And that was a real wake up call for me, that you have to ask the right questions to get good answers.
When I have a lot of new clients that come in, and obviously there's some people are better at understanding tax. They spend more time trying to understand it, and then there's some people that they're just like, I don't want anything to do with it. I don't know anything about it. But trying to understand your tax return is big, and I get a lot, like if I get a new client, there's not all the time, but a lot of times they'll say, do you have the time to review my stuff quarterly? Can we meet, twice a year to go over my stuff? And I think those are great questions to ask. If you're looking for a new accountant, that's questions that you want to be asking. I was like, are you going to, if I call you, can you help me with year-end tax planning? Yes. And if they say they don't do that, you may want to, go to the next accountant and interview that accountant. You know what I mean? So,
well, that leads me right into my next question. It's how do you go about finding or vetting a qualified accountant, or maybe even just finding the one that is the best fit for you?
So, in my opinion, it comes down to a comfort level, and a lot of the times you're moving from one accountant to a new one. Majority of the time. A lot of times people are just starting a new business too. It's like, I always used to have a W-2. I've always prepared my own. I think I need an accountant. Well, that's a good idea. But it comes down to a comfort level. And I wouldn't just pick one unless you have somebody that you trust that says, hey, I go to Mohatt Johnson and Godwin. Go give them a shot. And if you're comfortable with that because your friend gave you a good recommendation or whatever, that's fine. But if you're out there and you're just randomly cold calling accountants or looking at the society's website and looking for accountants, I would probably try to go talk to 2 or 3 of them and see who you have a good comfort level with. When I have clients that want a lawyer, I give them 2 or 3 names. I don't ever just say, yeah, just go to this one, because I want you to go sit down with each one of them and which one feels right to you. You can have a conversation with them and be like, I don't know. Something doesn't feel right. Something's off, whatever it is. And so I think that's the biggest thing, is just feeling comfortable with who you're talking to. And, do they feel like they're
there some specific questions that they could be or should be asking to kind of get that feel of whether it's a good fit?
Yeah, I think you need to have an idea of what services that you need. Go back to that conversation. Do you provide? I need bookkeeping services. Do you provide that? A lot of times, if you can find somebody that has the bookkeeping and the tax under one roof, sometimes that's it, because they just flow into each other, right? The bookkeeping, having good books, flows into the year-end tax planning and tax prep. And it's not an end-all be-all if they don't, but maybe could they recommend a contract bookkeeper? Maybe you don't have enough work to hire a in-house bookkeeper, and pay them whatever you need to pay them. And maybe they have recommendations for that. So figuring out exactly what services you have and figuring out if the accounting firm that you're talking to provides those services that you do need. I think that's a good question. But then again, do you provide consultations? Or, like in your situation, hey, I'm just here to prepare the tax return. Yeah. Like if you're comfortable with that, maybe that's a good fit for you. But it's not for everybody. So I think those are good questions.
We'll dive right into the nitty-gritty here for someone that's maybe starting to grow their business or even just starting out from scratch. Can you help us understand from an accounting perspective, maybe understand the difference between running a business as a sole proprietorship, an LLC, an S Corp, or a C Corp?
Yeah, that's a big question. And the thing in that question that jumps out at me is we're talking about a choice entity. I'm going to start a business, and how should I form this business? And people hear the word LLC all the time, and that's a limited liability company, but that's not a business structure, and it's probably one of the things I talk to clients the most about is they say, well, should I start an LLC? Well, yeah, that's fine. Start an LLC. An LLC is just it's a limited liability company that's set up with the Secretary of State in Wyoming or in whatever state. You have to tell the IRS doesn't even recognize LLC. You have to tell the IRS how you want your LLC to be taxed. And there's default methods. If it's just me and I'm going to start a new company and I create an LLC, I'm going to default to a sole proprietorship. Taxes, an LLC taxes the sole proprietorship. But you can have an LLC that's a C Corp, you can have an LLC that's an S Corp, you can have an LLC that's a partnership. So I think that's the first thing, is realizing that LLC is not a form of taxation.
It's really just a paper that you file that kind of creates this, okay, there's another entity over there, we're separate.
Yep. And it's a legal thing. We're talking about limited liability, and that's a legal issue. A lot of people use them. I believe Wyoming was one of the first states to use LLCs.
It's still one of, I guess, the states that is the simplest or has the most generous laws. I know a lot of people from other states form LLCs in Wyoming.
Yeah, and so the idea behind the LLC is that if something was to happen and there was some sort of legal action against you, the assets in the LLC are subject to that lawsuit, and the assets outside of the LLC are protected. Now, there's a lot of things that you need to do on a day-to-day basis to make sure that you're protecting the LLC and treating it as its own separate entity. So if you're a sole proprietor and you've got an LLC and you're still using your personal bank account, that LLC really ain't going to provide you any benefit, because you're commingling your money between personal and business and things like that. So that this is one of those questions too, where you go ask 5 or 10 accountants, would you rather be an S Corp, C Corp, or a partnership, and you might get 5, 10 different answers. I go to continuing ed, and there's some professors that teach those classes that live and die by partnerships, and they think that's the best choice of entity. They don't have any S corporations. There is a lot more flexibility with partnerships in terms of you can specifically allocate certain things. And S corps and C corps, you don't do that. So there's advantages. There's probably advantages to all of them, depending on what you're doing. If you're a real estate company You go buy a rental house and create an LLC. You don't want to put it into a C corp. We don't want to do that.
Yeah.
But maybe it's just a single member LLC, which is a sole proprietorship. So it's always a good conversation to have with your accountant when you're starting a new entity and do it early. Because you don't want to. We have people that start a partnership and they'll start paying themselves wages out of the partnerships as partners of the partnership. Well, you're not supposed to do that, But if you're an S corp, that's what you do. So, before you get too far down the rabbit hole and you're doing things you shouldn't be doing, and we have to unwind them, communicate early with your accountant on, hey, what do you think's best here?
So it sounds like each one probably has its own role depending on your ownership structure, the entity that you're running, what type of business or industry you're in. They're probably all a little bit different, but could you give us an example just from the tax perspective with each type? How does money flow through that entity to the owners, and what implications does that have on how it's taxed?
Yeah. So if you're a sole proprietorship, you get no deduction for the money that you take out of your own company. And you can put money in and you can pull money out as freely as you would like. There's just no deduction for pulling money out and putting it back in your personal account and your profits. And so you just, whatever your gross income less your expenses are, business expenses, not distributions, that's your taxable income. You're going to pay self-employment income tax on that. Partnerships are similar. You don't get a deduction for. You really don't get a deduction for any distributions out of a company, whether you're an S corp, whether you're a C corp or a partnership. They just reduce your basis. But partnerships, like if you work for the partnership, you would get what they call a guaranteed payment. And the partnerships and S corps are what we call pass-through entities. And your net income and in a partnership, your guaranteed payments, that's going to flow through to you on a K-1. Your K-1 gets reported on your individual income tax return. Sole proprietor gets reported on your individual income tax return. There is no K-1. So partnerships and S corps are similar in how that income flows through. C corps is they file their own tax return. They pay their own tax. Partnerships and S corps generally do not pay income tax.
Okay, so for an S corp and a C corp specifically, could you give us an example of a time that one would be more beneficial than the other?
Well, the C corps were kind of the thing. We see a lot of ranches, maybe they were set up back in the 50s and 60s or whatever, and they're all C corps. You don't see very many C corps anymore because C corps are known for having double taxation. So let's say you have a piece of land in a C corp and you sell it. The C corporation pays tax on gain on the sale of that land. Well, now you got the money from the sale of that property sitting in there, and anything comes out of the C corp is taxable to you. So you can take it out as a wage and get a W-2. That's taxable income to you. Or you can take a dividend from the C corp. Well, now you have dividend income, and so that's where the double taxation comes in. But right now, C corps have a flat tax of 21%. So if you have a very successful S corporation that's passing through income to you, and say you're in the 30% tax bracket, so that pass-through income is going out, and you're paying 30% on it. Well, if it was in a C corp, maybe you'd have been paying 21% on it.
Yeah, but after that 21%, then it's locked into that C corp, and you would be paying that 30% again to take it out. Is that right?
Yeah. Then the wages are coming out. It's going to go back to whatever your effective tax rate is on your individual income tax return.
Yeah, I have a lot of friends that own a C corp, and they have a ton of money in the C corp, but they feel like it's locked up because that money, they've already paid taxes on that money, but then to pull it out and spend it, they have to pay taxes again. So they feel kind of stuck. The money's locked away.
Well, and you feel that way, and C corps have rules that are net passive investment income rules that if a certain percentage of your income in a C corp is from passive activities and you're not distributing the money, there can be penalties for housing it in the C corp for too long. So things that again, kind of an advanced idea, but something that if you have C corps that you definitely want to be talking to your accountant about. There's also ways to make S elections in the C corp. Wait 5 years, and then after 5 years, you can pull those assets out as a distribution, which distributions out of an S corp are tax free. You don't have to pick it up as dividend income. But in that first 5 years, if you have an appreciated asset, then you sell it in that first 5 years, they're going to tax it as if you distributed it out of a C corp. Okay. And so and they call that a built-in gains tax by doing that. But if you wait the 5 years and let those assets sit there, all that appreciation, you can pull it out as a distribution out of an S corp tax-free, as long as you have a basis in your S corp stock.
Wow.
So we're kind of at some high level.
Yeah, it gets very complicated, very fast.
But like you said, if you're talking to your friends, it's like, hey, go talk to your accountant, and maybe an S corp election makes sense to you.
Yeah.
And we see that a lot too, like these old C corps. We've done where they're ready, thinking about retirement. And it's like, well, why don't we make an S election now? And then in 5 years, when you want to close this thing up, we're not going to have that double tax.
So you can roll something back from a C corp to an S corp. It just has that 5-year waiting period. Okay. I was under the impression that you could turn into a C corp, or if you had an S corp, you could turn into a C corp, but you couldn't roll it back.
Yeah.
Okay.
Yeah, like if you have an S election and you lose your S election, if they terminate your S election, you would default back to the C corp, which could be a bad thing. Okay,
so I guess correct me if I'm wrong here, but my understanding is generally for most like contractor type corporations outside of real estate or ranches or something like that, that an S corp in a state that allows it is usually the most beneficial, more so than like a sole proprietorship where you're going to pay Social Security and Medicare and federal taxes on what would have otherwise been distributions or profits. And in a C corp, you're stuck in the double taxation, having to pay taxes as the C corp and then again on the distributions. But an S corp allows you to pay yourself a salary and also pay distributions free of the Social Security and Medicare taxes. So you're only paying taxes once. So if we're painting with a really broad brush, is that accurate?
I tend to have a lot more S corps than I do partnerships. But like I said before, there's people out there practicing that will always favor a partnership. They'll figure out ways to try to manage the self-employment tax. So if your partnership is similar to the sole proprietor, all the income is subject to self-employment tax. The thing that S corps allow you to do, you're an employee of your own business, so you have to take what they call a reasonable wage out of that. The income, the net income that flows out on the K-1 is not subject to self-employment tax. So in essence, what you decide you pay yourself as a reasonable wage is what you're paying for self-employment taxes. Because when you pay yourself a wage, you got to withhold 1/2 of the Social Security and Medicare, and then the company pays the other half. You're the same person. So you're paying the whole thing. And so figuring out what reasonable compensation is, in the IRS, like a lot of things, they don't come out and tell you exactly what it is. Like I wrote something down. Reasonable compensation for like services by like businesses under like circumstances. That's how they define reasonable compensation. Now, there's been court cases that so there is some standards out there. There's been some rule of thumbs that people right here, take 50% wages, take 50% distributions. Be the highest paid person in your company. Those aren't going to stand up under IRS audit. But more than likely, if you're doing some of these general rule of thumbs, you're not going to get audited. In 20 years, I've never had a reasonable comp audit in our office where we've had to try to defend what we paid them. But I've seen court cases where I remember this one that sticks out, and it was a dentist's office, and one of the dental hygienists was making just a little bit more money than the dentist, and they said that's not reasonable compensation. But if you look at it, it's like, okay, well, the dentist probably is going to make more money than the dental hygienist. Yeah. But even in a small business that does, a small blue collar business, who's the most valuable person in the organization? It's probably you. So you should be the highest paid person. If you're an S corp, you should be the highest paid person in your corporation. You're the face of the corporation. So yeah, they're figuring out reasonable compensation. The one thing I would say is don't ever make it zero. Don't set up an S corporation and not pay yourself wages and distribute all the money out to. A lot of clients want to. All the taxpayers want to know what are the red flags. The IRS unfortunately doesn't give those to us. But if you're taking zero wages and distributing out, $50,000, $100,000, $200,000 in distributions a year, you're going to get audited eventually.
So, sorry, I'm getting into more of a specific example here, but would that remain true for like a silent partner or an owner that is not actively working in the business? Do they need to be pulling a salary as well, or can they take only distributions?
So 2% shareholders are the ones that need to take reasonable compensation. But if you look at kind of their bright line rules, so you could say, I own a roofing company. What do other roofing companies pay the general managers of their company? Because say it's $100,000 a year, and you're paying yourself 20. Maybe that's not reasonable. Or you could look at it and say, what's a fair market value average hourly wage? And here's my hours I worked this week. Pay me. So if you have a silent partner, even if they own more than 2% of the company and they're doing nothing for the company, it's just an investment for them, you wouldn't be required to pay them a salary. No. There's one line on the tax return and it says officers' compensation. And so you put a number on there. The officers that you're paying. It doesn't. I don't think there's a requirement that says every single officer has to be paid a wage.
Gotcha.
They're doing nothing for the company.
Because that was how I'd always looked at the reasonable compensation. Was if you look at if you were not an owner or not an officer, but were doing that workload, what would you expect to pay that person? And if you're in that range, that should be reasonable. And that's a pretty safe approach.
Yep.
Okay.
Yep. They're good conversations to have with your accountant, at least to get a comfort level on, is this too, typically the conversation is this too little of an amount to pay myself? Because obviously the goal is to push down your wages and increase your distributions. That's the goal. But at the same time, you don't want to open yourself up to an audit unnecessarily. So pay yourself a reasonable wage.
Something that gets thrown a lot, and I personally think there's a lot of misconceptions about, is tax deductions. We hear everybody talking about tax deductions and doing this for the deduction or getting the deduction for that, and yet the vast majority of tax filers takes advantage of the standard deduction rather than itemizing. Can you help us understand the difference? What is the standard deduction, and when and who should be concerned about tax deductions?
Well, I think all taxpayers should be, to some extent. I mean, it's something that should be analyzed. I mean, so the IRS, the standard deduction is just an amount that the IRS says this is what, if you're single, this is the amount you get. If you're married, this is the amount you get. So, for single, I think it's around $15,000 now. For married, it's a little over 30. That's just double. But we used to have a lot of people that itemize their deductions, but several years ago, 2017, I think it was. They went in and they almost doubled the standard deduction. So unless you were paying mortgage interest, or you had large charitable donations, or maybe you're elderly and your medical expenses are just through the roof, a lot of people that used to itemize didn't anymore. So you're and taking the standard deductions, there's nothing wrong with that. But if you have a mortgage, or you give charitable donations of any sizable amount, or maybe you have a specific thing that happened during the year medically, it's always the question to ask is, ask your accountant, do you want me to round up my medical expenses? Do you want me to round up my donations? Do you want me to, the mortgage interest is easy. We're just giving your mortgage interest statement, right? But now, with this new tax law that's coming out, things are going to change again. Everybody's probably heard of the SALT deduction. The state and local income tax deduction got limited to 10,000. Well, now that's going to 40. So people that, maybe you live and work in Colorado and you have to pay Colorado state income tax. Well, that may help you. Now, property taxes, and there's ways. And you want to talk to your accountant about this too, because if you're right on that threshold of, say you're married and you got $29,000 in deductions, so you're going to take the standard deduction. But there's ways to where you can say, well, a bunch of my charitable donations this year, I'm going to double up and pay all of my property taxes in 1 year versus paying one half and, just paying one half. And so you can make that extra property tax payment, things like that. And, like bunching donations, you can give it, instead of waiting until January 1st to give your 2026 donation, give it on December 31st, even though you've already given them a donation in that same year. And then, if you're worried about the charity saying, well, you didn't give us anything in 26, just go talk to them and let them know what you're doing. I'm doing some tax planning here and I'm going to double it up this year, but you may not get anything in 26. So what you end up doing is 1 year you're going to itemize, you're going to save a little bit of tax. The next year you're probably not going to itemize. Then the next year you'll probably, so there's some tax planning that can go into that. If you don't have any mortgage interest and you don't give money away to charities and things like that, you're probably not going to itemize it. You don't need to worry about it.
Yeah.
But it's a good conversation to have.
So the standard deduction is an amount that you can write off as a deduction with no proof, no evidence. You don't have to track it. You don't actually even have to have those deductions. You can just claim it automatically. So if someone's deductions, their mortgage interest, charitable donations, medical expenses, local taxes, all of that, if they're nowhere near that standard deduction threshold, they're going to take the standard deduction, and what they give, their charitable giving, isn't going to matter a lot on their taxes. And you never have to provide a backup for the standard deduction to the IRS. This is just an amount they give you. And so if your deductions are close to crossing over that standard deduction amount, that's where you really need to be paying attention, gathering everything up, having the evidence, and being ready to present that.
Yep. If you're going to itemize, then you're going to want to make sure that your donation receipts have the correct verbiage on them and things like that. You're going to want to save those for the 7 years, and in case you get audited and all that. But if you're not itemizing, there's nothing to save. You can throw away your medical bills and your donation receipts and things like that.
Gotcha. So a family that's maybe average. I think the average household income in the U.S. is like $78,000 this year, and the standard deduction of having a $30,000 deduction for a married couple, most people are going to fit into that bucket where they're taking the standard deduction. But if you have a much higher income, like you said, or have a special event that causes some higher level charitable donations, or a big medical expense or something that is going to throw you over that amount, you really want to pay attention to those deductions and think about itemizing.
And for 2025, if you give me a second.
Oh, man, you're prepared. I'm pulling stuff out of thin air, and you're over here with actual numbers.
Well, as part of this change, okay, it's going to be for 2026. So in 2026, they're going to offer, and they did this a few years ago. They gave everybody like up to a $300 deduction for charitable donations, even if you didn't itemize. That's coming back in 2026, and it's going to be up to 2,000. So if you're the person that buys a calendar here, for $25 and does this for $100, throughout the year, but it doesn't add up to a lot to help you itemize. Keep in mind in 26, you want to keep those receipts because you will get a benefit out of it. And it has nothing to do with itemizing or the standard deduction, but you'll get it right off on your tax return. So yeah, that could help anybody that gives just a little here and there.
We're going to dive into something that, based on my limited understanding, is a bit of a pet peeve of mine. So maybe you can correct me if I'm wrong, or set the record straight, or maybe confirm for everybody else out there. But especially in the contractor world, it seems like everybody is wandering around and they love to throw around, oh, I bought a new truck because my accountant told me I needed to for the write-off. If you don't need something, is it ever a benefit to spend money specifically for the, quote, write-off?
I do not advise my clients to just go buy equipment to save taxes if they don't need the equipment. I think taxes is about the only thing we do where you say, I'll go spend $1 to save 20 cents. If you need a new pickup, it's going to help you. You're going to get a write-off for it. But I think a lot of it comes down to, let's try to manage our tax liability. Let's not try to make it zero every year. I have a lot of clients that are 100% tax adverse. They don't want to spend $1 to the IRS, and they, so they don't take my advice, and that's fine. It's their choice. But I think preserving cash can be a good idea sometimes.
Yeah, thank you. That clarifies my position. It's always a net loss if you do something just for the tax write-off. If you need a new piece of equipment, or maybe even if you just want that new pickup and you were considering spending money on it anyway, that's great. Absolutely. Take the write-off. Take advantage of every write-off, every tax benefit you can get. But if you're doing something for the sole purpose of the write-off, you're going to be money behind. It's always going to be a net loss.
That's how I look at it. If I have a client sitting there talking to me about how they're looking at buying something in, January, February, March, I'll be like, well, you might as well just, maybe their taxable income's up in this year, but they're looking at buying the equipment the first part of the next year. It's like, well, why don't you buy it now? That's a good idea because you're going to buy it anyways. You need that piece of equipment. But if you're just like, how much taxable income, because I have clients do this, their tax planning is tell me what my taxable income is so I know how much money I'm going to spend to zero out.
I was just going to say, I feel like that's one of those areas where you have to make sure you're asking the right question. If you ask your accountant, how do I reduce my taxes? Well, buying a bunch of stuff and writing it off will reduce your taxes. But if you ask the better question of, how do I end up with the most money at the end of the story after any taxes I might have to pay have been paid, you might get a different answer.
Yeah. If you just keep, and I've had situations over the years where this happens, and you communicate to them that it's probably going to happen. If you're just out there buying equipment, and pretty soon you don't have any cash, or maybe everything you've bought you've had to finance. Now you're in a situation where maybe the banks aren't as willing to give you the money to buy equipment. So then you come into this year where it's like, I didn't have the money and I couldn't get the financing, and you can't buy anything. And then you've accelerated the depreciation on everything you bought in previous years. You're going to get stuck with a big tax bill, and it's going to hurt. So that's where I like to try to avoid, and it's not always easy to avoid, but you owe zero tax this year, you owe a bunch this next year. These big peaks and valleys, and it's like, let's try to let's figure out a tax bracket that works best for you, and let's try to keep you in there as close as we can and manage that tax liability. Is kind of the way is my approach to that. And try to, but there's this big thing between, we're trying to make the balance sheet look as good as possible for banking purposes, right? Yeah. Or other issues maybe down the road. But for tax purposes, you want it to look as terrible as possible so you don't have to pay tax. So there's a fine line in how to balance that. And there's ways to do it. But I just think in the long run, you can get yourself into trouble if all you're worried about is just buying equipment and you don't need the equipment. Because maybe you might be losing money on the equipment and you're not using it, or maybe you're not making enough profit off the equipment because you're not using it. So I think one way or another, you're probably losing if that's your only approach.
It makes me cringe. Every year in December, I have a whole pile of friends that say it. Oh, yeah, I bought a new truck because my accountant told me I had to. Or, yeah, check out my new skid steer because the accountant told me I needed to spend some money. And I always just roll my eyes. I'm like, man, you are asking the wrong questions. Okay. Can you help us understand some of this other accountant language, other stuff that gets thrown around a lot? What is the difference between a tax credit and a tax deduction?
Tax credits are a dollar for dollar reduction of your tax liability. Examples of tax credits are like, some people may get an earned income tax credit, child tax credits, dependent care credits. So if you qualify for those type of credits, and they're just going to reduce your tax dollar for dollar. And then there's a few of these credits, certain education credits, the additional child tax credit, the earned income credit, they're actually refundable. So if you have a $1,000 liability, but you've got a $3,000 education credit, you're going to get a $2,000 refund, right? So some of them are refundable, but the opposite of that is the just a deduction versus a credit. So if you take a $1,000 deduction and your tax rate, your effective tax rate is 20%, you're going to save 20 cents or $20 on that $1,000, right? So it's not, deductions are not dollar for dollar. They reduce your taxable income dollar for dollar, but then that's times your effective tax rate, and that's your savings.
Gotcha. So tying into our last topic here a little bit, if there's a tax credit available, you want to take advantage of that every time. That's a dollar for dollar. You're going to reduce your taxes. It's basically whatever you're spending that money on, you're going to get that for free because you're going to get a credit to cover what you spend. But a deduction is only going to reduce your taxes by your tax rate. So we only want to take advantage of deductions if that is something that you would have done anyway.
Yeah, I mean, you want to maximize your deductions, obviously, for taxes. I mean, if you spend how much ever on, insurance, it's not like, well, let's just take half of it this year. But yeah, you want to take as many deductions as possible to try to reduce your taxable income for sure. Okay. Yeah. The other, and part of, going back to that conversation we were having about buying equipment earlier, is have conversations with your accountants about, if you do need to buy new equipment and you want to buy a piece of equipment, do you need to fully depreciate it all in 1 year? Do you need to accelerate it? Another general rule of thumb is that if you finance equipment, don't accelerate the depreciation on financed equipment. So have that conversation with your accountant. It's like, do I need to fully depreciate this year, or can I preserve some of it over the next 5 to 7 years?
Okay, so something you've helped me understand a little bit is that a lot of tax deductions are not necessarily forever. They're more of a deferral. And especially when it comes to real estate, this is something I'm still trying to get my head wrapped around, but maybe you can help us out here. I hear a lot of people, they invest in real estate because of all the tax deductions. That's something they're chasing and going into real estate. So you get all these deductions in real estate, but then when you go to sell that piece of real estate, you're going to end up paying capital gains on all of those things that you deducted along the way. So it might still be an advantage. You get to kick the can down the road and pay it later, but it's not going away forever.
Part of good tax planning is kicking the tax liability down the road. can we defer this tax liability to a later year? So there's some of that, and I think the deduction that you're mainly getting at, and especially with real estate, is depreciation. When I was young, I had a partner of one of the firms I worked for in Casper. He said depreciation is an interest-free loan from the government, because what happens is you're getting, you depreciate a residential rental house over 27 and a half years, and so you're getting a little bit of depreciation every year, and you get 10 years down the road and you want to sell it. Well, what you're doing is you have to recapture depreciation, and recapture depreciation is ordinary income. So you think that I'm selling this and it's all going to be capital gain income. Well, a piece of it's ordinary. So you've converted capital gain income into ordinary income due to this depreciation recapture. And so that's where they say, it's an interest-free loan. They're going to get you on the back end with the depreciation, which is fine. There's nothing wrong with that, but you just got to be prepared. You can't just take the 15% capital gain rate, 10-year gain, and say that's what my tax is going to be. It could be worse than that. It's going to be some sort of a blended rate type of a deal. You can take deductions for retirement expenses, but that's income to you later. When you start in retirement, unless you're in some sort of Roth IRA or something like that, your retirement income is going to become taxable to you down the road, but you've got deductions for it up front. But that's why they're going to make you pay tax on it down the road. The other one, let's see. But deferring taxes, just to the bigger point, deferring taxes is kind of the idea.
You're gaining that inflation along the way. You can pay that tax with future dollars that are worth less than today's dollars.
Well, there's a lot of tax planning, and we go back to real estate. A lot of people everybody's heard of like-kind exchanges. We call them 1031s. And first, if you're thinking about doing one of these, talk to your accountant early, because once you touch the money after closing, there's no going back on it. The like-kind exchange opportunity is gone. The money's got to be held in escrow, but the whole idea behind a like-kind exchange is all you're doing is deferring that tax until you sell the second property, because all you're doing is reducing the basis in that next property that you bought by the gain from the previous property. And so now you have a bigger gain on the next property. But maybe there's tax planning involved. Maybe you hold on to that property and it goes to your heirs after you die, and they get a stepped up basis, and nobody ever pays any tax on it. But those are kind of, if you can have conversations about how to defer tax, kick it down the road. That's really a lot of tax planning, I think, because again, the idea is that we kick the liability down the road. So we're going to save taxes currently by taking the depreciation. I think you would want to do that for sure. Yeah, you just have to be careful in that situation. A lot of people, it's pretty popular. Let's go buy a house, fix it up, and sell it. That's a little bit different situation, because that technically should not be capital gain income. If you're flipping houses, that would be kind of more of a trader business and subject to self-employment type. So if you're into flipping houses, let's fix it up. Let's rent it out for a year or two. Not sell it. But if all you do go make improvements, and it takes you start on a year and a day, and you sell it after you flipped it, that's going to be self-employment income.
These are all the reasons somebody needs a CPA. I could get myself in jail accidentally.
You're probably talking to a lot of people that have the ability to go do that. They can go do the work themselves, which makes flipping houses appealing. But you might want to talk to the accountant about it. It's not necessarily just capital gain income.
Yeah. If you're out there trying to do your own taxes, you can land yourself in trouble with the IRS real quick. So, okay, this is probably going to be a really popular question. What are the most common deductions that people miss or don't think of?
No, that's a good question too. And obviously, you got a set of books, and all the business expenses are getting paid out of the business account. We're probably not missing much, but you might have a small business, and you got your cell phone set up on an individual plan, and the bill's coming to you personally. It's okay, because all small business owners are giving out their cell phone number, right? Probably on their business card. It's okay to have the business write you a check, and you can do it reimburse you for your cell phone. If you sit at home and you use the home internet, the home office deduction, there is a home office deduction, but it's usually pretty small deduction.
That's one of those that you might be able to defer a little bit, but it comes through eventually.
Like, say you got your internet at the house, and you have the internet to run your business. You can, the key is just any of these small expenses that you're paying out of pocket personally, but they're business related. Just from your business to you personally, just write yourself a reimbursement check, cell phone reimbursement, internet reimbursement. Another one is for self-employed people. There's a lot of rules related to self-employed health insurance, and so if you're paying health insurance, make sure you're communicating that to to the account so that you can get self-employed health insurance deductions, or if you're an S corp, that it's getting accounted for correctly, because there's some special rules with self-employed health insurance and S corporations for 2% shareholders. Asking about retirement opportunities. I mean, I try to encourage, especially the younger generation that are going out starting their own business and doing this. It's like, get started early. What's a good retirement plan for me to get started? And even if it's just a little bit of money to start, and because it's gonna help you down the road. My daughter just started teaching this year, and I told her, I said, the first thing you do is fill out that retirement form and never see it in your paycheck, and never make that excuse, well, I'll start that in a year, I'll start that in 2 years, because it's going to be a lot longer than that before you probably finally do that. But HSAs, if you have HSAs, make sure you communicate that you got an HSA to your account, and there's deductions related to that. And then the big ones, vehicles. If you got a sole proprietorship or a single member LLC, and the truck's in your name, figuring out what's the best way to handle that vehicle. Do we want to take the actual expenses related to it? Do I just want to have my company reimburse me for mileage? And there's no set standard that says it has to be paid monthly, it has to be paid quarterly. All this could be done at the end of the year, or you can do it monthly. But tracking those, and the IRS wants to see you moving money, paying physical money from the business to you individually. I'm not saying I've never done it, but a lot of times accountants do it through journal entries. Hey, they contributed this and they got a deduction. But there's no money that changed hands. So you want to actually physically pay the money between the company and yourself on those things, whether it's reimbursing mileage or whatever. So I would say those are probably the big ones that I can think of off the top of my head.
Something I hear from a lot of small business owners, again, they say, well, I'm self-employed, I don't have a retirement, or they think that kind of the big corporate 401k is the only way to do retirement. What retirement vehicles are available for small business owners or someone that is self-employed?
Well, there's different types of IRAs that you can use. There's one's called a SEP IRA. And there's rules related to SEPs. If you have employees, then there's rules about when they qualify for that plan, how many hours they've worked, how old they are, and things like that. And if you contribute 20% of your net income, then you have to contribute 20% for everybody that qualifies. But SEP IRAs are a good vehicle. There's just individual retirement accounts that aren't necessarily tied to your business. If you qualify to put $7,000 into a traditional IRA and you do that, you can get a deduction for that. And there's limitations and rules, of course, but then again, you want to talk to your accountant about, well, is a traditional IRA the best for me right now, or maybe a Roth IRA is better for me, and I'm not going to get a current deduction, but it's going to grow tax-free until I retire. And when I retire, I'll pull money out of it, and I have no taxable income, right? And so you want to have those type of conversations too. But you can have a simple IRA. You can have 401ks. So there's all kinds of opportunities to start putting money away and get a tax advantage out of it. Versus you can just have a regular brokerage account. You can start piling money into that, but you're not getting the current tax deduction for any of the money that goes into it. So maybe, if you've got that excess cash to do that, putting some into your brokerage account, but also taking advantage of your deductions through your retirement.
Yeah. So just because you don't work for a big corporation that has a 401k that you can sign up for does not mean that you're excluded from participating in a retirement plan.
Correct. There's opportunities out there for just the solo business worker for sure.
What are some things business owners could do to best prepare for tax season? Or maybe what are the frustrations you have with clients that if you could get in front of them and teach them a lesson of, hey, if you do this, and this, it would make my life way better. What can we all be doing to help make your life easier?
Most accountants, starting with something as simple as they send out the tax organizer every January. And really all that is just it's just kind of a guide of what you had last year. Familiarize yourself with what you did have last year. It'll show you the prior year numbers, and that's what we're looking for to collect in the current year. At the front of it, it'll be 2 or 3 pages of yes and no questions. Fill out those yes and no questions, and let us know if things have changed from one. I mean, I've filed tax returns because the couples have forgot to tell me they had a baby. That's stuff that we need to know. I mean, it's been several years ago. I had one lady that didn't tell me that she got remarried. So all these life-changing events need to be communicated, and there's questions in there that are yes, no, and you just simply say yes and explain it, and whatever. But it helps you gather up all the information. I think one of the things that can slow down tax prep is just piecemealing things. I got a 1099 in the mail today, I better run it down to the tax account, but we can't do anything with it because we're waiting on the other 15 things we need. Yeah. So try to get as much information as you can gathered up by going through that tax organizer and bringing it in all at once. Whether you're the client that likes to go in and sit down and go through it with your accountant, or that you just like to drop it off and tell me when it's ready to have it with and there's nothing wrong with you. Or just drop it in a Dropbox like I do for you guys. If we're missing something or we have questions about something, I mean, there's nothing wrong with that method because we're going to call you and we're going to get it figured out. But something simple like that. I have a lot of people that just don't even open the envelope, And again, I think it just goes back to this is taxes. I don't want anything to do with it. Tell me what I need. The businesses, the clients that have the businesses, whether it's an S corp or a partnership or just a sole proprietor, those are a little bit different. You want to go through and try to make sure your books are in some sort of working order and trying to do some year-end cleanup, or if you need help getting the books cleaned up, we can start doing that type of stuff in November and December to kind of get us that much further ahead. Because we got to start thinking about, do we need W-2 prepared? Do we need 1099s prepared? And do we need to send out stuff to get the information to file the 1099s? So there's some cleanup work there. So whether that's your in-house bookkeeper or you do that work yourself, or asking for help to help get the books cleaned up, so we're kind of closer to ready to go to work on the taxes. It's hard when you get somebody that doesn't do a good job with taking care of their books, and they bring it in March to try to have the time to try to get that done by April 15th. It's going to be an extended client more than likely, and a lot of clients be like, "Oh, that's fine," but just trying to be prepared. And we ask all of our clients, we want copies of your purchase invoices. Did you buy new equipment? Give us the purchase invoice. Because they'll forget to tell us that they traded. They'll say, "Oh, I bought this for $50,000." Well, they won't tell us they traded something else, and then the actual cost of the equipment was $150, or whatever. So we're always looking for purchase invoices on your big purchases. We got to gather up loan histories if you have loans with the banks. What we do at our firm is we go through what we call a balance sheet approach. We're going to make sure your cash is reconciled at December 31st. Your fixed assets are accounted for. Is accounts receivable? Are all the accounts receivables reasonable? Are they collectible? We just go down the balance sheet. Are the loans tied out? Because we feel like if the balance sheet's tied out, then your income statement and what we're reporting as income has got to be pretty close. Okay. To where it needs to be. So it's not always foolproof, but yeah, started bugging them and saying, "Can I get in there for a year-end tax planning appointment? And let's figure out where I'm at, and what I need to do." It just helps cut down on surprises at the end of the year. Like, hey, you stuck me with a big tax bill this year. It's like, well, I haven't heard from you since last year when you picked up your tax return. Yeah, I didn't know you had a better year this year. So communicating that type of stuff and trying to get ahead of where you're at with your tax liability, I would say. But I think one of the things that small business owners, like you've always had a pretty good grasp on how your taxes work and where you're going and things like that. But there's people that are the complete opposite of that just want nothing to do with it, because maybe it's stressful for them or they're busy doing something else. I would encourage all small business owners to try to understand their tax return. Try to figure out a way to just the basics of what's driving my tax liability. Why am I paying $20,000 a year? And what can I do to help preserve that a little bit by just gaining a little bit of an understanding of how this works. Even if you don't want to, you don't like it, you don't understand it, ask stupid questions. Because to me, they're not stupid questions. And I get encouraged when I have my clients coming in and just asking me the most basic questions, because it shows me that they're trying, that they care, that they're engaged. And when I see people doing that, typically their businesses are a little more successful, just because they're helping manage that tax liability.
Yeah, I can see that. I mean, I'm in the field talking to other contractors and stuff, and there's a lot of them, they get mad at their CPA because they owe more in taxes this year than they did last year, and they can't explain why. And I'm like, it's probably not your CPA's fault. They're filling out the forms, following the process, and if your tax bill went up, it's because something changed in your business, not because your CPA did a bad job.
I think that's the most frustrating part is getting a big tax bill and not expecting it. But you've got to communicate. Go back to the communication part and communicate early, communicate often about where you're at. If you go pick up a big job and it's going to be done by the end of the year, it's going to increase your revenue twofold from the prior year, you should be communicating with somebody about that. Not just plop it down in March. And
So I remember this very clearly because it was not the answer I wanted to hear, but one of the first years after I bought my business from my dad, I had an unexpectedly large tax bill, and I was having coffee with him and was complaining about it, and he goes, "Well, you have a huge tax bill because you had a huge year. You made a lot of money this year. Pay your taxes and quit complaining about it." Like, you have a tax bill because you made a lot of money. So use some of that money to get the IRS off your back and move on with your life.
And I've given that exact message to clients that your dad gave to you, and it doesn't always go over well. That's not what they want to hear. But there's situations where it's like, hey, you did well. We're managing tax liability here. We're not trying to get rid of it 100%. And you're still getting ahead, even though you're paying some taxes. But like I said, the biggest thing is getting stuck with that big bill. Because maybe they spent all the money on buying equipment, but they couldn't get rid of the whole tax liability. And it's like, well, what am I going to pay the tax with? And they're just, and then there's just the idea of having to write a check to the IRS. It just drives people crazy. No, it's not. I write them too, and I don't like it either. But
maybe this is a similar question, and it's just something that's been on my mind lately with what we've been working together on. But how can owners best prepare for a liquidity event or an exit? How can we prepare our books to sell our business or transfer to somebody else?
I think it's a good question. It shouldn't start at the end. You know what I mean? And when you're talking like prepare the books, you go into business and in your mind, you're thinking, maybe I'll build this business up and I can sell it. Or maybe the kids want to take it over or whatever, but there's going to be a buy-sell. They got to buy data out on or whatever. where we want to make sure that we're trying to build that balance sheet from day one. You know, the business, yeah, cash is important, but it's not the only asset of the business, you know. And so, you know, you got these cash only businesses, and people want to take payment under the table and stuff like that. But when people go in to buy your business, they're going to be looking at maybe the last 5 years of tax returns, and they're going to take the numbers that are on that tax return. You know, so if we've got a ton of bogus deductions that are, you know, you're mixing up a bunch of personal deductions and things like that, or you're not reporting revenue, or you know, whatever, you're not doing a good job of building that balance sheet. You know, you want to make that look as attractive as possible at the end of the day when we're getting close to like, hey, it's time to do some succession planning. You know, you get to within 3 to 5 years of retiring, and you're like, the balance sheet looks terrible. Well, you know, you're gonna have to find somebody, and I'm not saying you can't, but you're gonna have to go find somebody and convince them of what you've been doing, and hope they trust you that is what you were doing, and it really makes us much money versus just doing it the right way and reporting the income, you know, keeping the personal expenses out of it, and building that balance sheet up and making it look like a valuable asset to some third party that wants to come in and buy your business from you. So in terms of getting the books ready, I think that's got to start from day one. You know, and I have conversations with clients about that all the time. What if you want to sell this someday? You know, but they're so young that they don't. That's not what they're thinking about.
You mentioned it earlier, more in light of like banking and finance, but there's just this weird dichotomy where like you want your banker to think that you're making a lot of money, and you want the IRS to think that you're making none. And so it's kind of the same thing here. And I know this is a learning curve for us. It's a process we've gone through for a while, but same sort of thing. You want a new buyer to think you're making the most amount of money possible, and you still want the IRS to think you're making the least amount of possible, so you're paying the least taxes.
And there's things you can do to, you know, if the bank wants to see a financial statement, but your books are in terrible condition, it's, you know, it's hard to put together a financial statement. So we're always focused on the balance sheet and making sure the balance sheet's in good order. You know, most of our taxes are done on a cash basis, but if you have receivables and payables and things like that that are an accrual basis tax item or accounting item, you can go give the bank an accrual basis financial statement. You don't have to give your tax return. You can say, yeah, but here's my tax return, but that doesn't include my receivables. Here's my receivables, and they're all collectible, and I'm going to collect them in the next 60 days or whatever. So you can do what we call a compiled financial statement for the bank that goes with your tax return, and you can do that on an accrual basis. You know? And so that's one way that you can help kind of walk that line of, I need something that looks good, but on the tax side, I need, you know, something that's going to show I'm not making any money.
Yeah, so we're back to some of this terminology that gets thrown around a lot, and many of us probably don't understand it very well. What is the difference between accounting on a cash basis and accounting on an accrual basis?
So cash basis is really just what it is. You pay tax on the cash you receive, and you get to deduct the cash you spend, you know, between January and December on your cash basis. Whereas accrual basis, you know, if you have accounts receivable, you've done the work, and the work's done by December 31st, but, you know, maybe you're not going to get paid till January of the following year. You're going to pay tax on that income in the current year. Because on an accrual basis, you've earned that income, but you haven't received the cash. But it works the same way with accounts payable. You know, like I've incurred this liability, but I haven't paid it until next year, so you're going to get that in the current year. And so that's kind of the biggest difference.
Is there maybe different types of industry or maybe different sizes of businesses? If somebody's just trying to get their arms around their accounting and trying to do it properly, is there a time or a situation where it would make more sense to keep your books and do accounting on a cash basis versus an accrual basis?
I would, if you have receivables and payables and stuff like that, our clients are they're tracking them on an accrual basis. We make what we call tax journal entries to adjust from accrual to cash for tax purposes. And sometimes we do that inside your books. We'll make a journal entry as a 1231, and we'll reverse it as a 1-1, so that you're back to the accrual basis.
it's less maybe the size of business or the type of business, and it's more if you provide services and get paid in cash that day, you can probably run on a cash basis. But if you have receivables or payables, either one, you probably need to be tracking it on an accrual basis.
Let's recommend tracking it in your accounting system, whether that's QuickBooks or you have some Excel situation set up for yourself because you don't want to pay for QuickBooks, whatever it is, but you definitely should be tracking your.
That's good to know. I've heard people give the advice before that when you start out and it's a small business, you just track your cash, and eventually when you get big enough, it's going to need to switch to an accrual-based accounting, but I guess that's not necessarily the case.
From the very beginning, I'd start working off an accrual basis balance sheet inside your accounting system. Okay. Your accountants can make adjustments for the accrual to cash adjustments to get what we need to report on the tax return.
That's good to know. I'm learning new stuff today.
We talked about the book side of that, but there's a lot of planning that goes into transitioning businesses, right? And your parents transitioned the business to you, and now you're transitioning again. So you've been through this a few times, but you want to again communicate early what's going on, what your ideas are of how to do this, because there could be situations where there's tax savings available. There's installment sales versus lump sum payments. There's transferring it through gift, or there's transferring it through inheritance. One has a carryover basis, one gets a stepped up basis. So there's a lot of different factors, and in certain situations, like especially with like a C corp, for example, if you meet certain standards and you're a C corp, you could sell your business and not have to recognize the gain on the sale of it. But it's pretty limited, but there's a rule out there. Or if you're going to recognize the loss, capital losses in the accounting world are terrible because you're limited to $3,000 a year. Well, there's a rule out there for the sale of business stock that if you sell it and you recognize a loss, you can treat, like, I think it's up to $100,000 of it as ordinary income, which is all deductible in 1 year. So there's different situations where you want to be talking to your accountants early about this type of succession planning and things and how to structure them with your attorneys, and different ways to try to save taxes on the transition on the sale of the business.
Yeah, that C Corp rule was something that caught me off guard a little bit. For the longest time, I was like, S Corp, S Corp, S Corp. You don't ever do a C Corp unless you have to, because they just seem like a nightmare. But then when we were preparing for the sale of our business, I stumbled onto that C Corp rule and was like, oh man, this is the one scenario where that would be really nice. I would love to not be paying taxes on all of this.
Yeah, we don't see it very often because I think you got to be the original owner of the C Corp, and the capitalization of the C Corp has to be under a certain amount, which a lot of our small businesses fall into that around here. And so there's different rules, but you definitely want to go down that avenue to explore it.
Okay.
Yeah.
What is one thing about bookkeeping or taxes that people just don't seem to get?
Bookkeeping and taxes. I think if you don't understand bookkeeping, debits and credits, you're probably better off focusing on what you're really good at. Use your time and resources to go generate revenue versus trying to spend the time messing up your books. And it's no different for me. I need to focus on, in my job, where can I generate the most revenue, and I need to delegate. We talked about that earlier. I need to delegate this to somebody else so I can, be focusing on this. And I think that that's good for anybody in a small business. If you don't know what you're doing, and then you got input into QuickBooks that means nothing, then you go take it to your accountant, he can't make heads or tails of it. You've wasted your time. In all reality, you're better off finding somebody that knows how to do it, whether that's a third-party contract bookkeeper, or that's somebody that you've hired, or maybe it's the accountant in-house bookkeeper that's helping you with that. So from a bookkeeping standpoint, it's just focus on what you're good at and if you don't know anything about the bookkeeping, the accounting, ask questions.
I think that might be one of the unsung heroes of the Industrial Revolution is specialization. Instead of doing everything yourself, use specialists to do it. We have employees or people all the time that give me a hard time because I don't change the oil in all of our company trucks. And man, if I am out roofing, I can make more money roofing in the same amount of time that it takes to change my oil as what it costs to pay somebody else to do it. And the guy running the oil change place, he can probably make more money changing oil in the amount of time it takes to fix his roof than what he would pay to have me do it. So just hire a professional and let them take care of it.
I agree 100%. And I get it. I try to manage costs in our business too. And but you got to think about the lost revenue, not doing what you're good at. Yeah. Because you can make more money then you're going to go pay somebody to do this.
And especially in your industry, I mean, changing your oil is one thing, but you're not going to wind up in jail because you did it wrong. And with taxes, that might not be the case.
Right.
This is super random, but that comment reminded me. I was reading a book one time, and the author said that he instructed his lawyer and his accountant on the 3 to 5 rule. He always wanted to absolutely push the envelope on legality of avoiding taxes, but if he were to get caught, he wanted his lawyer to be able to get him out in less than 3 to 5 years.
I had there's this couple, and they're good friends of mine, and they moved to town. And, she's like, all right, well, I need you to start doing our taxes. And I said, okay, I can do that for you. And she goes, your number one job is to keep my husband out of jail. So he's clearly one of the tax adverse clients I have, but yeah, she's like, make sure that he doesn't go.
I think a lot of us probably fall into that category. You don't want to pay more in taxes than you have to. So what is one piece of advice that you would give to a small business owner or an entrepreneur to help set them up for success? If you had only one piece of advice, what would you tell them?
It's been mentioned, but it's trying to understand taxes to the best of your ability, and making relying on your accountant to explain it to you. Go in and ask questions, figure out what's driving your tax liability. Maybe they have ideas on. We're not always the perfect advice from industry to industry to help you run your business, because I don't know anything about roofing. I don't know anything about changing oil. But we can definitely help you understand what's driving the tax situation and where you're at, and ways that we can maybe try to limit the tax liability. And with that is build a team of advisors around you to get the help that you need. Whether that's you have a lawyer, you have a financial advisor, a retirement advisor, an insurance guy or gal, build a team around you of people, and whether it's, and maybe it's just mentors. Maybe you're young and you grew up and you've got successful business people around you that have been through the trials and tribulations that you're getting into, and talking to them. But yeah, building a team around you of people that you can trust and rely on to help you grow the business, and that allows you to go focus and do what you do well and build your business.
One of my favorite sayings is, you don't know what you don't know. So what are the questions that I haven't asked? Or maybe what are the questions that your clients don't ask?
I can't think of any questions they don't ask off the top of my head. I think it just kind of goes back to the conversations. I have a lot of clients that drop their stuff off and pick them up at the front desk, and I'll see them once a year. They're not asking questions probably because they feel like the questions they have are stupid questions, or something to that effect. And so I would just mainly just say, don't be afraid to ask the questions. Because it could be something simple, or you could be onto something that maybe is a little more complicated. So any questions that you think of, whether it's through an email or a phone call, or just ask the questions. ask any and all questions. That's what you're paying us for, is to advise you and help you understand what,
Well, this is my favorite question that I ask of every guest. Uh, are you a person of a particular faith tradition? And if so, how has that affected the way that you run your business?
Well, I grew up going to church every Sunday with Mom. Grew up in a Lutheran household. Um, Today, I don't go to church every Sunday, but I guess I'm just more of a spiritual person. And, I do a lot of probably self-talking in my head to God. I'm very thankful for where I'm at. And I know there's reasons other than just, me working hard to get here. There's other things that I've been blessed with, and then, asking for, help looking over my kids and my grandkids and, things like that. But in my business, I just wanted to look at everybody the same. Whether it's an employee, whether it's the gal working the front desk, or it's one of my bookkeepers, or it's one of my partners. I look at them all the same, and I try to do the same thing with clients. I don't worry. I've been doing it long enough that a number's a number. I don't care if you're worth 0 or 30 million. It's like I look at everybody the same, and that's kind of the biggest thing I've taken away from that spiritual type thing. Thank you.
If somebody is interested in engaging your services or chatting with you about CPA services in more depth, what's going to be the best way to get a hold of you?
We actually have an office in Buffalo, and we got an office in Sheridan. So yeah, just call in the office. We refer to them as cold calls, and we have an intake sheet that the gals that answer the phone will help get that filled out, and gets passed on to the partners, and then we just kind of we contact you back. Right now, in our firm, the first question you're probably going to be asked is, are you open to being extended? And because we just can't promise people at this point that you're not going to get extended, so we want to be very upfront with that. But yeah,
So do you deal mostly or maybe even exclusively with local clients, or would you be interested in long distance clients as well?
We have clients in several states. It's one of those things where we've kind of moved to where we're trying to focus more on local clients, instead of dealing with people from out of state. But we've had clients for years and years, and then they decide to move in retirement and things like that. And we don't get rid of them. And I'm not saying that we wouldn't take on a client from out of state, but our main focus is Sheridan County and Johnson County, and trying to take care of those clients. Okay.
Is there somebody that you think would make a good guest on the show? Somebody that has a unique story, a unique business, or maybe works in a really unique industry that would be fun to learn more about?
I thought about this quite a bit, and there's one name that comes to mind, and it's Bryce Fisher. And I don't know if you know Bryce, but he was, when I became partner, he was my very first client that I picked up on my own through a referral. And so we got to be getting close to 20 years. And he was very young, and he started out, and he's grown a successful business in the heavy machinery and reclamation work and things like that. And he's just continuing to grow and doing very well. I think from a young entrepreneur standpoint, I think Bryce would fit the bill for sure. But I also like what you did today. Helping your listeners out by talking to advisors. So that maybe there's some bankers out there that or financial advisors that would be able to come on and provide some insight to your listeners as well. I think that kind of go full circle on that.
Those are two great ideas. I'm going to have to explore that and Yeah, we might have to make that happen. And I do know Bryce. I had not yet thought of him to bring him on the show, but I think he'd be great. I've known him for quite a while also.
Yeah, he popped in my head right away.
That's great. All right, so last question to either settle or fuel the debate. If you have a job to do and have to pick a cordless tool, which brand do you prefer?
I really try to practice what I preach. If I don't know how to do it, I'm going to rely on your listeners to come in and give me a hand.
Okay, fair enough. Well, Dan, thank you so much for joining us. It really has been a pleasure. I think the advice you've given is wonderful, and I hope that people listening really take it to heart.
Yeah, no, thank you. I hope that I've given you some advice that can help you somewhere along the way.
Yes, and I really appreciate all you've done for us and for joining us today. So thank you. And thank you guys for joining us here on From the Ground Up Show. If you want to reach out and join us on the show as an expert, or if you have a question that you want to ask of one of our expert guests, you can find us online fromthegroundupshow.com or on social media at From the Ground Up Show. Again, if you guys are enjoying the content, please like, share, subscribe, follow, all the things. It would really mean a lot to us if you could leave a 5-star review. Those 5-star reviews go a long ways towards moving us up in the algorithms. And make sure you click that auto download button so that each episode gets downloaded automatically every week. Until next time, keep grinding.